This is some of the most absurd tax planning I have ever heard of. If you guys missed this, Caleb Williams, the first round pick in the NFL draft, when negotiating his salary with the Chicago Bears, asked that they not pay him as an employee of the NFL, but instead pay his LLC. He even floated the idea of having his income structured as a forgivable loan. And what's crazy about this is that I know somebody out there is going to be pulling up to their job asking their boss to do the same thing. We're going to break all this down. Is this actually legit or is this all BS? I promise you, you don't want to miss it. Welcome back, guys. Be sure to hit that like and subscribe button if you like today's content. And of course, if you need help with your own financial plan, reach out to us at www.modernwealth.com. That's modern spelled with no vowels, wealth.com. So let's break down this proposal in two parts. First, let's break down the LLC proposal in and of itself. Now, the idea was that the LLC would avoid state income tax in the state of Illinois. Brilliant, right? Well, not really. Here's the deal with an LLC. An LLC in and of itself gives you zero tax benefits. And I know that's going to shock a lot of people, but I will say it again. An LLC gives you zero tax benefits. An LLC is by default considered a disregarded entity in the eyes of the IRS. So this means that if you go set up an LLC, the money you make in it flows directly back to you and you file it on your tax return. This is true on the federal level as well as the state level, even in Illinois. So bottom line is, simply having an LLC doesn't magically absolve you from having to claim income taxes associated with your business. In Caleb Williams' case, even if the NFL elected to pay him effectively as a 1099 contractor and have that money paid to a business entity that is an LLC, he still needs to file federal and state income taxes on those dollars. So the second part of the proposal was that Caleb Williams and his team floated the idea of having his contract structured as a forgivable loan so that he can avoid income tax entirely. Again, might seem savvy on the surface, but it's actually baloney. This would have been blatant tax evasion if he would have structured this. And the reality is that the IRS has their sights on ultra high net worth individuals like this. And on top of that, he's a public figure. And the reason for this is that it's blatantly income. Just because you want to work out a hypothetical arrangement that structures your income as a forgivable loan doesn't absolve you from income tax filing requirements on it. Again, the idea here is that the loan, because it was considered forgivable since inception, isn't really a loan. Now, if you're thinking, well, don't super rich people use loans to legally avoid taxes all the time? You're 100% correct. Wealthy individuals use loans to circumvent primarily capital gains taxes all the time. This is generally done by collateralizing an asset like real estate or even a stock portfolio and choosing to borrow against that asset. The reason why this is done is that if the asset is sold, the individual would be walking into a massive tax bill at an effective tax rate of nearly 40% in many cases. However, if they borrow against that asset at, let's say, a rate of 7%, they can keep the asset and get the cash they need, and all they have to worry about is paying interest rather than tax. This type of loan structure here is generally 100% legal and legitimate. However, asking your employer to structure your paycheck as a forgivable loan probably isn't going to fly in the eyes of the IRS. Another piece of this analysis I know someone out there is going to wonder about is the LLC element. If LLCs don't help you save on taxes and have zero tax benefit, why set one up in the first place? Well, the main reason why people set up LLCs, whether you are someone as wealthy as Caleb Williams or just someone looking to set up a business for the first time, is to draw a line between your personal assets and business assets. So let's say that you set up a cookie shop and you get sued by someone saying that your cookies made them super sick. Your personal assets generally are off limits in this case because the entity being sued is your LLC associated with your cookie shop, not you personally. If you want to learn more about LLCs and how they work in the context of setting up a business, we did an entire podcast episode on this, which I will link in the description. So there you have it, guys. If you found this video helpful, if you're actually looking for legit tax help from a certified financial planner, reach out to us at www.modernwealth.com. That's modern spelled with no vowels, wealth.com. And of course, give this episode a like and subscribe if you enjoyed it. We'll see you next time, guys.